99% of people lose money in the stock market, not because they're stupid, not because the market is rigged, but because they never learned the one mindset that separates winners from losers. Warren Buffett calls this book the best investing book ever written and says it changed his life at 19. After reading it myself, I realized why most investors are destined to fail and how you can join the 1% who actually get rich. Here's what nobody tells you about investing. You think you're smart because you bought Tesla or GameStop and made some money? That was investing. That was gambling. And gamblers always lose in the long run. The average investor returns 2.9% per year, while the S&P 500 returns 10%. Why? Because when markets crash, they panic and sell at the bottom. When stocks explode, they get greedy and buy at the top. They turn investing into an emotional roller coaster that destroys wealth instead of building it. Benjamin Graham wrote this book after surviving the 1929 crash that wiped out 90% of investors. He figured out the psychology behind why smart people make dumb money decisions. And if you don't understand the psychology, you're doomed to repeat the same expensive mistakes. Imagine you own a profitable coffee shop. Every morning, this crazy guy named Mr. Market knocks on your door with a new offer. Monday, I'll pay you $2 million. Coffee is the future. Tuesday, coffee is dead. I'll give you $200,000. Take it or leave it. Wednesday, actually $800,000. Coffee is hot again. Would you sell your business based on his mood swings? Hell no. You'd think he's insane. But here's the shocking part. This is exactly how most people treat stocks. When Mr. Market is happy, prices go up and everyone thinks they're geniuses. When he's sad, prices crash and everyone panics. Graham's genius insight. Mr. Market is there to serve you, not guide you. When he's depressed and offering low prices, that's when you buy. When he's manic and offering crazy high prices, that's when you sell. The 2020 crash, that was Mr. Market having a breakdown, offering amazing companies at fire sale prices. The smart money didn't panic, they went shopping. Let's destroy the biggest lie in finance, that speculation and investment are the same thing. They're not even close. Investing is like buying a rental property. You research the neighborhood, check the cash flow, understand what you're buying. Speculation is like buying a lottery ticket because your cousin's friend said it's lucky. Most people think they're investing when they're actually speculating. They buy stocks because someone on TikTok said so. The price is going up. It's trending on Reddit. They heard a hot tip. Real investors ask different questions. What does this company actually do? How much money do they make? Are they growing? What happens if the economy tanks? If you can't answer these questions, you're not investing. You're gambling with your future. The dot-com crash wiped out trillions because people were buying anything with .com in the name. Zero revenue? Didn't matter. No business model? Who cares? Then reality hit and fortunes vanished overnight. Don't be that person. Here's the secret weapon that protects intelligent investors from disaster. Margin of safety. Never pay full price for anything, especially stocks. Why? Because even the smartest people make mistakes. Companies fail, markets crash, economies collapse. You need a cushion. If you're building a bridge for 10-ton trucks, do you build it for exactly 10 tons? No way. You build it for 30 tons just in case. That's your safety margin. Same with investing. Let's say Apple is worth $150 per share. Do you buy at $150? Not even at $140. You wait until it hits $100 or less. That $50 gap is your protection. If you're wrong about the value, you still make money. If you're right, you make a fortune. Warren Buffett used this principle to survive every market crash for 60 plus years. During 2008, while everyone was panicking, he was buying great companies at massive discounts. Why? Huge margin of safety. The man doesn't lose money because he never buys without protection. Graham discovered something crucial. There are only two types of successful investors. Pick one or stay broke forever. First type, the defensive investor. These people have lives outside of investing. They don't want to research stocks all day. They just want to build wealth slowly and safely. Defensive strategy is boring but beautiful. Buy low-cost index funds. Dollar cost average every month. Ignore the noise. Rebalance once a year. That's it. No stock picking, no timing the market, no following gurus. Just systematic wealth building that beats 90% of professional fund managers. Second type, the enterprising investor. These people treat investing like a second job. They read financial statements for fun. They hunt for undervalued companies like detectives solving mysteries. They're willing to work harder than everyone else to find real bargains. But here's the trap. There's no middle ground. Either you go full defensive or full enterprising. The middle is where people get destroyed. They think they can pick a few stocks without doing the work. That's how you turn into a speculator. Your biggest enemy isn't market crashes or bad companies. It's your own emotions. Graham discovered that successful investing isn't about intelligence. It's about emotional discipline. The smartest people often make the dumbest investment decisions because they let feelings drive their choices. Market drops 10%? Fear screams, sell everything. Stock doubles overnight? Greed whispers, buy more, you'll get rich. Both emotions are wealth destroyers. Fear makes you sell at the bottom. Greed makes you buy at the top. Look at any market crash. 2000, 2008, 2020, the pattern is always the same. Panic selling followed by regret when prices recover. The people who got rich were the ones who stayed calm, stuck to their system, and bought when others were selling. How do you beat your emotions? Simple. Have rules and follow them religiously. Automate your investments. Dollar cost average. Never make decisions when you're emotional. Treat investing like flying a plane through turbulence. You don't panic and jerk the controls. You trust your instruments and stay the course. While you're worried about market volatility, inflation is silently stealing your wealth. At 3% inflation, your money loses half its purchasing power in 23 years. That safe savings account paying 0.5%, you're guaranteed to lose money after inflation. This is why intelligent investors must own stocks and real assets, not to get rich quick, but to preserve buying power over time. Companies can raise prices with inflation, your cash cannot. Over the long term, stocks are the only reliable protection against the hidden tax of inflation. Your grandparents could buy a house for $20,000. Today, that same house costs $400,000. Don't let inflation do this to your retirement. Here's your step-by-step action plan. First, change your mindset. Treat every stock like buying a piece of a real business. If you wouldn't buy the entire company, don't buy a share. Second, never pay full price. Wait for your margin of safety. Great businesses at wrong prices are still bad deals. Third, pick your investor type. Defensive? Buy index funds and chill. Enterprising? Start studying financial statements. No middle ground. Fourth, build emotional discipline. Create rules, automate investments, ignore the noise. Your emotions will try to sabotage you. Don't let them. Fifth, protect against inflation. Own assets that can grow with rising prices. The Intelligent Investor isn't just a book, but a manual for financial survival. These principles worked in 1949, they worked in 2008, they're working today. Because human psychology never changes. Fear, greed, panic, euphoria, these emotions drive markets just like they always have. Your wealth isn't built by being right about tomorrow's stock prices. It's built by understanding timeless principles and applying them consistently for decades. The market will test you repeatedly. Having these principles is your armor. Remember, you don't rise to the level of your goals, you fall to the level of your systems. Build intelligent systems, and wealth will follow. If you found this video helpful and don't want to miss more like these, hit that subscribe button to get latest updates of new videos. Let me know in the comments which principle hit you the hardest. The book link is below. It's the foundation every serious wealth builder needs.